Hey everybody, I'm going to work one more problem out of chapter 1 showing how to record transactions in the accounting equation and then prepare financial statements. And since we're about to start chapter 2, I'm going to use a problem from chapter 2 so that when we get over into that chapter we can kind of talk about some of the differences. So I'm going to be working problem 2.1, that's on page 71. But I've actually got the transactions here for you to look at. So I'm going to get my picture out of the way. And so I've got the transactions here. And we're going to record these in the context of the accounting equation. So real quickly, remember that the accounting equation is assets equals liabilities plus owner's equity. And our job in recording these transactions is to analyze the transaction and ask ourselves what in the accounting equation was affected and did it go up or down. So, for example, in the first one, transaction A says we collected $10,000 and issued common stock to the stockholders. So that's typically the first thing that's going to happen when a business gets started is the owners invest money to start the business. And so from the company's perspective, this is the company's accounting equation. The company now has $10,000 of cash that it didn't have before. And that money came from the owners, and we call that common stock. So that represents money that came from the owners. We call that, another way to refer to it is paid in capital, money that came in from the owners. So remember, in the accounting equation, on the left side of the equation, we're going to keep up with all of the assets that the company has. Those are things that the company owns that it can use in the future. We'll give it a future benefit. On the right side of the equation, we're going to keep up with where the money came from to get those assets. So we can borrow the money, meaning we have to pay it back. The money can come out of the owner's pocket, like this $10,000 that we just got, and that represents the owner's investment. We call that common stock. And then hopefully we will operate the company in a profitable way, and we will keep up with everything related to profit, revenues that we earn minus expenses that we incur. All of that will be kept up in this retained earnings column. So we'll come to that as we go. Okay, item B is we pay 2 years rent in advance, $4,800. That's $200 a month. So sometimes a company will get into some sort of a lease agreement and they may pay some money up front. So in this case, just for illustration purposes, we paid for 24 months, 2 years in advance. And so we're going to subtract from cash $4,800, and we're going to add to prepaid rent. So this rent that we've paid in advance, we have the future benefit of using this office for the next 24 months. And so that's definitely an asset that we have. Item C says that we provided $62,000 of services to clients. We got $48,000 in cash, and the other $14,000 is on account. So remember, anytime you do work, in this case we're providing services to clients, anytime you do work, you're going to add revenue under retained earnings. So anything you do in that retained earnings column, whether you add or subtract out to the right, you need to indicate what that is. So this $62,000 plus to retained earnings as revenue indicates that we did $62,000 of work. The other question is, did we collect the money yet? Well, we did collect $48,000 in cash, so that'll be added to cash. And the other $14,000 they still owe to us. So anything that the customers owe to us represents a future benefit. We will be collecting that money in the future. So that's an asset. So add to accounts receivable. Anytime we are the customer and we buy something on account from a vendor or something, and that would be a liability. We would call that accounts payable. We don't have that in this example. So that was transaction C. Item D is we paid $21,000 in wages to employees. So we paid $21,000 cash, that reduces cash, and we are paying our employees for work that they did. That's already in the past. We're not paying for a future benefit, we're paying for what they've already done. That's an expense. And so we will subtract wages expense under retained earnings. Item E, we collected $8,000 in advance from clients. Okay, so we haven't done the work yet. We collected cash. Cash went up. But we still owe them this service. So we're going to add to unearned revenue. It's a liability. We still owe them this work. Item F, we collected $9,000 on account from clients. So again, we're collecting money from clients, but this time we're collecting it on their account. In other words, it's related to this $14,000 up here. They owed us for work we had already done. We sent them a bill, and now they're paying us. So we're adding to cash $9,000, but this time the accounts receivable is coming down. The amount that they owe us is coming down because they're paying off that balance. So keep in mind, in these last two transactions, the $8,000 we collected in E, that was for work that we have not yet done yet. We are adding that to a liability because we still owe them something. In F, we're collecting money for work that we had already done, so that reduces what they owe us. Item G, we paid a dividend to the stockholders of $3,000. So we're going to subtract $3,000 from cash. And under retained earnings, a dividend represents a distribution of profit. And so we're reducing how much of that profit or earnings we are retaining. So it reduces retained earnings. So remember that we don't call it dividend expense. Dividends is not an expense of running the business. It's simply a distribution of the profit to the owners. Item H, we provided $5,500 of services to clients who had paid in advance in E. Up in E, we collected $8,000 in advance. We owed them some work. And now in H, we're doing some of that work. So that reduces that liability, and this is now revenue that we have earned. So remember, when you do the work is when you record the revenue. Revenue is a plus under retained earnings. No cash is involved in this transaction. They had already paid us in the past. We are just now earning it. And then finally, in I, it says we recorded the expired portion of rent as of the end of the year. So we paid this back at the beginning. We paid for 2 years in advance, and now 8 months has expired. So apparently we paid for it back, May 1st is when we started, May 1st. So when 8 months expires, that's at $200 a month, that would be $1,600. So we're going to reduce the prepaid rent for the amount that has expired, $1,600, and that expired portion is now relates to the past, so that's a $1,600 rent expense. So both sides of the equation have come down. So then we will total up all of the columns, make sure that our equation is still in balance. If you add up these assets, they will equal the liabilities and owner's equity. And then we're going to make financial statements. Remember, the first financial statement is the income statement. And the income statement needs to indicate what time period is being covered. In this case, we started May the 1st and went through the end of December, so that would be 8 months. So this income statement is for this 8-month time period. Everything on the income statement, revenues and expenses, comes from the retained earnings column. So we're going to go through here and pick up the revenues. I'll tell you what I'm going to do. I'm going to go ahead and color code this just so you can see what I'm doing. So here's revenue, and there's a revenue. And so we're going to add up the revenues, and that adds up to $67,500. That goes on the income statement. And then we're also going to pick up the expenses. So there's wages expense, and the dividend does not go on the income statement. Rent expense does. So we can list out our expenses, subtract those expenses. Here's under expenses, we had wages and rent, total expenses of $22,600. Subtract that from our revenues, and our net income is $44,900. So remember, the income statement formula is revenues minus expenses. Then the next financial statement is the statement of retained earnings. Statement of retained earnings covers the same time period as the income statement. So it's for 8 months. And it explains how we got from that number at the top of the column, which is 0, to the number at the bottom of the column, which is $41,900. And the formula for the statement of retained earnings is beginning retained earnings, which was 0, plus the net income, which we already calculated over here on the income statement, $44,900. Minus dividends. Well, $3,000 of dividends is a reduction in retained earnings. And that's how we got to the ending retained earnings of $41,900 at the bottom of the column. So again, the formula for the statement of retained earnings is the beginning retained earnings plus net income minus the dividends equals the ending retained earnings. And those formulas are all on page 16 if you want to look at that. Finally, the balance sheet for this company, and the balance sheet does not cover a period of time. Let's see, what color can we put this? I'll put it in green. It simply says, on this day, these are the balances we have on December 31st, and those balances are going to come from all of these column totals. That's what goes on the balance sheet. So you're going to list out your assets, list out your liabilities, and your owner's equity. So here that is. So our assets add up to $54,400. We only have one liability. That's the remaining portion of that unearned revenue, representing what they have paid us in advance. And then the two components of owner's equity is the common stock and the retained earnings. And so the total stockholders' equity is $51,900. And if we add that to the liabilities, total liabilities of stockholders' equity is $54,400, which is the same as the total assets. So we recorded everything in all the transactions in the accounting equation. We totaled it up, and then we summarized all of this information in the chart on the financial statements. And in the file that is listed in that I'm going to be sending you to go with this. There is a template on the separate tab that you could look at if you wanted to print that off and kind of work this on your own, and then go back and look at it. So that's just one more review, and we're going to be actually using this problem as we start into chapter 2 and talk about we're going to wind up with the same financial statements, but we're going to be recording things with what's called debits and credits, and we'll talk about that in chapter 2. So just a quick review of the recording process in chapter 1. I hope that was helpful.